Now we're going to talk about the constructive receipt doctrine. Constructive receipt doctrine. It applies to cash basis taxpayers. All individuals are cash basis. Very rarely have I ever seen an individual be allowed to use accrual basis, but generally individuals are tax basis. Now, a lot of entities, partnerships, trusts, corporations may choose, if they wish, to report their income on a cash basis as opposed to an accrual basis. And you can switch from one method to another. However, you can't just willy-nilly switch every year, go back and forth. Generally, you're limited to, I think it's once in every 5 years. But generally, we're talking here about, under the constructive receipt doctrine, we're talking about a cash basis taxpayer. And it's really quite simple this way. It's taxable when it's received. Now, that seems pretty clear. But sometimes people have a strange notion about what constitutes receipt. See, there are income that you can choose to not receive it directly. Now, you might say, well, I've never seen that. And my answer to your comment is, oh, yes, you have. If you own mutual funds, sometimes if you just own stock in a company where you're allowed to reinvest the dividends and let it accumulate. And that might be a wonderful idea from a financial well-being, but that's your choice. You could have taken the dividend. And now, yes, it goes into your account and you didn't take it, but you can. So that's why a lot of times people are confused. Let's say that you have money invested with a broker or a financial planner, and you get this 1099 that says your percentage or your share of dividends, non-dividend distributions, capital gains, capital losses. Okay? Most taxpayers, if it's their share of a loss, they think that's wonderful. But if it's their share of a gain, oh, well, I didn't get it. Well, yes, you did. It's your choice. So if, in fact, the deferral of the receipt is your choice and you have the ability to take it whenever you want to take it, then it's going to be receipt. It's the doctrine of constructive receipt. I did talk about mutual funds. How about a CD? Somebody buys a CD and they allow it to compound and continue to grow. Another one some people will try and it won't work is, and I see this with some independent contractors, they'll get a check near the end of the year. Let's say they get it on December 30th, and they don't deposit it until January 2nd. Well, they could have deposited it when they got it. So yes, it is taxable. You can't just hold the check and not pay it. So the doctrine of constructive receipt is fairly simple. If you have access to it, then, unrestricted access to it, then fine. Now, on the other hand, if taking it out, you can take it, but it's going to result in some sort of penalty, that's a different story.